stock market. It's got to retain the value so there's confidence in the economy. All these arguments have been argued since Greenspan ran the Fed. So the whole situation is one for a dollar collapse. And, I think people who think that inflation is a process, a mathematical process, have got this entirely wrong. Because firstly, the foreigners will lose faith in it, and that will drive it down. And as the foreigners lose faith in it, you will find that US institutions start losing faith in it. And the last people to lose faith in it, of course, will be the general public in America. And they will then learn the hard way, once the dollar's lost another 99% of its purchasing power or more, they will then learn that it's not prices going up, but it's their dollar going down. And at that point, they'll start dumping it. And then it's finished. Game over.
Alasdair Macleod warns the dollar could lose 50 to 90% of its value in the next 12 to 24 months as the fiat system reaches its end. He says gold could triple or quadruple. Stocks may crash 95% when priced in gold. Commodities could surge 10 times. And $1.2 trillion in margin debt makes the equity bubble impossible to save. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
Basically, China has been controlling the silver price for the last 3 decades. It started with the rare earths. It decided, you ain't getting rare earths. And when the silver price started rising, I think China realized that it had to make a choice. Do we continue to suppress the price at the risk that we lose our strategic stocks, because they built up strategic stocks? I mean, bear in mind that China is the second largest silver miner, and also it is the largest processor of both silver, doré, and also metallic ores, copper, zinc, lead, and all the rest of it, where you find silver. So they have accumulated huge quantities of silver. They have been the swing factor in the price. That is absolutely clear if you actually look at the facts. So what she's done, basically, is she's decided to not completely remove supplies into the West, but to control them more closely. And this was really behind the new licensing regime, which applies from this January and is due to be in place for the next 2 years. It's not what gold's value is; it's the dollar. It's the dollar's loss of value which will be driving it. I mean, by the end of this year, that the gold-dollar exchange rate could well triple or quadruple. I don't know. It depends how fast the dollar goes down. It's interesting if you look at the Reichsmark model. I mean, we're at the point, really, where the collapse in the purchasing power really does begin to accelerate. And that's what the gold price is telling us. It's that moment, if you like, that they had in Germany in the second half of 1921, when the gold price really started rising. This was before prices really started rising again. And the stock market was in its last run. The end of the run was December the 1st, where there was it effectively collapsed. The stock market collapsed, and you saw gold, double, triple, quadruple from there. The effect, if you like, of a fiat dollar has been to suppress, in real terms, the value of base metals. It's also true of other commodities, incidentally, but we concentrate on base metals here. If you look at base metals priced in gold, which is money, and over long periods of time is relatively constant in its purchasing power, you can see that these base metals are extremely cheap. I calculate a basket put together by the IMF to be around about 18% where they were. If you like, up until Bretton Woods was abandoned. 18%. What that tells us is that in real terms, in other words, priced in gold, they're going to rise 4 or 5 times before they are overbought. Now, if at the same time the purchasing power of the dollar is going down, you can see that over the next year or two, the dollar price of this basket, and it includes copper, is going to be quite a bit more than that. I mean, we could easily see it 10 times as much. That is the consequence of a collapsing purchasing power of the dollar. And of course, there are knock-on ramifications for that, because you're going to get higher consumer prices. I mean, wholesale prices, obviously, then consumer prices. And that does mean that you're going to get higher bond yields. And higher bond yields will pop the equity bubble. So, this is a situation where I think both the dollar and the US is in an extremely fragile position. The point about what's going to pop the bubble is that it'll be credit withdrawn, in effect, from the stock market. Now, how does that come about? Well, the answer basically is the other side of credit is debt. And we've seen how debt has been accelerating. Once you see bond yields begin to break out of that consolidation period, we've had a consolidation period which runs back to late 2022, I think, without looking at the chart. And we're waiting for that to break out. Japan has already broken out. You can see the long end of the bond market, the German bond market, that's already broken out. Others are sort of going that way. That's going to happen. And when that happens, that pops the bubble, because you've already got a huge, huge difference in terms of value between the returns, the interest return, the coupon returns, as it were, in bonds, and the rating in stocks. By my calculations, it is now greater than it has ever been in history, greater than in 1929. And that's quite some statement. So what you're going to see, I think, is a combination of credit being withdrawn by banks. And bear in mind also, if you look at the FINRA figures, on margin debt, I think it was I last saw it in, I think it was November was the last figures we've got, was about 1.2 trillion. Now, that's with the brokers. The brokers don't create credit. They go to the banks in order to get that credit. So that's bank credit aimed at stocks. Now, on top of that, hedge funds and insurance companies, whatever, where they leverage their positions, they don't go through the brokers, they go direct to the banks. So the FINRA numbers are just the tip of the iceberg. And consequently, when the banks find that the value of the collateral starts falling, they're going to be selling the stuff out into a falling market. I mean, that's exactly what happened in Wall Street, late 1929, and going on from the rally, the primary rally, which lasted, I think, until about May 1930, and then it just went down and down and down and down to an eventual bottom in the middle of 1932. The attack on America is going to be financial. Putting myself in Xi's shoes, I would just bring down the dollar. I mean, it's an extreme thing to do, but having laid the groundwork with CIPS, the Chinese settlement system, which excludes the dollar, having laid the groundwork for a yuan which is exchangeable, which will be, it is already exchangeable for gold. It's just that the rate hasn't been fixed. That is something that could happen. Fix the rate. And what does that do to confidence in the dollar? I think it kills it. So there are moves on the financial side which the Chinese can do. They've still got something like 600 billion of US treasuries. They've probably hedged the risk in that to a large degree. We don't know. But that's something which they could bring into play. I think also there's a feeling that Trump's targeting BRICS because, for a start, Argentina accepted membership of BRICS, and then when Milei got in, that was rescinded for American support, as it were. Brazil, I have no doubt that Brazil is a candidate for regime change, which again, being the B in BRICS, is a very, very important development. you've also got conflict over copper developing, I think, in the Democratic Congo Republic, or DRC, Democratic Republic of Congo, and also Zambia, which is trying very, very hard to stay neutral in all this. So you can see that things are actually hotting up, particularly on the commodity side. And I suspect that part of China's thinking in terms of letting the silver price rip was it's an extension, if you like, of their policy, their rare earth policy. They know what hurts America, and that's high commodity prices. So commodity, I mean, look at the price of copper. That's gone through the roof. So I think there are some very, very big headwinds heading America's way. And this is not, the way to deal with Trump is not to try and declare war on him or escalate military conflict, but basically undermine his currency, and that will make him powerless. Looking at gold is the wrong thing. Look at the purchasing power of the dollar. As that collapses, obviously the price of everything rises. Now, we're going to have in this year, I mean, there is going to be no doubt at all, we're going to have higher consumer prices this year, and they will be significantly higher. Nobody's expecting this, but it's the only outcome that makes any sense whatsoever. So as they go higher, what you will get is the political response. Everybody knows that the most stupid thing you can do, is to introduce price controls. But what will happen? The easiest thing to forecast is price controls. Why? Because politically, they will be seen to be necessary, even by people in politics who understand how counterproductive price controls are. That's the way that this is going, and it will just collapse the purchasing power of the dollar even further. I mean, this is a situation which is just post-Bretton Woods, end of the fiat currency system. And when you end the fiat currency system, unless you tie the fiat currency to gold, it goes down to zero. And I think this is a 2-year process maximum. It could even be a year to 18 months. I don't know. We have to see how quickly it happens. A lot of gold disappeared into the market when they tried to rig the market in the 70s to drive gold out of the system. We know that there was a massive carry trade out of bullion, lease bullion. Your leasing costs were 0.5%, 1% tops. And at the time, you could sell it into the market and apply the dollar proceeds to US treasuries, which were yielding anything from 10% down to 5%, from the early 1980s onwards. So where did that go? Well, an analyst called Frank Veneroso reckoned that it all went into the market, never to be seen again. He thought it was probably adorning the necks of Asian women, which I think was a slightly flippant remark, but it was something that made the point. I reckon that China was in there picking it up, because it was really from 1983 onwards, China basically embarked on a program of secretly buying gold. And, they had a wonderful bear market to do it. And when did the States suddenly decide that it could let its own citizens in on the act? That was at the bottom of the market in 2002. And the Shanghai Gold Exchange was then opened. And since then, the general public have taken delivery of something like 28,000 tons of gold. And that's in addition to anything which Chinese government acquired. We're not talking about the People's Bank's reserves at all. That's a completely different thing. But what they acquired, I reckon they could easily have acquired between 20 and 25,000 tons by 2002. And they have continued to acquire gold since then. I think at a lesser pace, admittedly. But they've got ample reserves. And a lot of those reserves would have come out of Fort Knox, in effect, as a result of America's attempts to drive gold out of the system and replace it with the dollar.